Well, welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. Term sheets tend to favor the founder over the investor or the other way around. Here's how to tell if you have a founder-friendly term sheet. Valuation skews to the higher end of the market in favor of the founders. There's no liquidation preference for the investors. The option pool shares will be paid for by both founders and investors and not founders alone. There are no performance reviews nor non-compete clauses for the founders. There are no dividends paid to the preferred shareholders. The term sheet uses a broad-based weighted average for anti-dilution and includes provisions for the investors to pay to play. The investors must pay their own legal expenses. The term sheet does not force arbitration, which means that founders and investors can use the courts. Look for these key points in the proposed term sheet to indicate which party it favors. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start up something today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.